Hey everybody, hope you're doing great today. In today's video, I'm going to discuss commercial real estate and whether there is a commercial real estate bubble. So whether you're interested in the economy in general or you are a commercial real estate investor and you're curious about the current state of commercial real estate, this video is for you. So how do we know if commercial real estate is in a bubble? First thing first is you have to evaluate based on equal numbers. So when you're measuring commercial real estate returns, you need to compare it to other returns. For example, I will compare them to government treasury bond returns and compare the capitalization rate for commercial real estate to see if there is a bubble. And I will look at other data and statistics as well to look at the situation around commercial real estate and to see if it's in a bubble or not. So first thing first, we need to understand how commercial real estate is evaluated so that we can compare like numbers with like numbers. So in this case, I'm going to look at the capitalization rate, or cap rate for short. What the cap rate is basically a measure of the rate of return a commercial property will be providing to the owner based on certain numbers. And as we see here from Investopedia, the measure is computed based on the net income which the property is expected to generate and calculated by dividing the net operating income by the property asset value and is expressed as a percentage. So all real estate is not equal. While certain areas and certain types of investment property might be in a bubble, others might not be. It also varies deal by deal. There are a lot of deals out there. So even if we find that the commercial real estate market is in a bubble, that doesn't mean you can't find deals individually by knocking on doors, cold calling, whatnot, basically chasing leads down and figuring out, okay, is this a good deal or not, running the numbers and figuring that out. But in terms of a current deal, let's take a look at this one deal right here. This happens to be a listing for a Starbucks store. Basically, it's a triple net lease. And if you don't know what a triple net lease is, that's basically when the company or the individual renting the space that's being leased is basically paying for everything. They're paying for taxes, they're paying for insurance, and they're paying for all the upkeep, maintenance. The only thing the owner is doing is collecting rent. So in this case, we have a Starbucks here located in Plainview, Texas. And I'm just picking this at random. I have no affiliation or relation with this listing here at all. As you can see, it's a single tenant property. It's a Starbucks. The net operating income is $115,000 per year. And based on the asking price of this property, converting that to a cap rate, we get 4.75%. So basically, you're getting 4.75% return on your investment by purchasing this property. I did cover in another video whether the housing market is in a bubble, and you can take a look at that video. I'll leave a link to that above. And in that video, my opinion was yes, that housing is in a bubble. So let's compare commercial real estate to government bonds, to CDs, and see whether it makes sense to invest in something that's a 4.75% cap rate like that Starbucks I showed earlier, and compare these to government bonds, government treasury bonds. So as we can see here, US Treasury bond, a 3-month is 4.806%, 6 months is 4.9%, 9-month 4.9%. If you want to go out a little further, 3 years 4.235%, all the way up to the 10-year here, you have a 3.915%, as well as looking at the CDs. These are brokered CDs, which are available through your stockbroker. So in my case, I'm looking on my E-Trade website, but regardless of whatever broker you use, they should have similar options, similar features. The same thing here, look at a 3-month CD, 4.5%, 6 months, 4.75%. You go out to 5 years, 10 years, 5%, 4.75%. So the point I'm making is you can get a risk-free rate of return either through a US government treasury bond or through some of these CDs that are FDI insured. Park your money there instead. You're going to get an equivalent rate of return compared to that Starbucks, and it's going to be very low risk. Like when it comes to a single property tenant, like I showed over there with that Starbucks, that's one tenant. If that tenant decides to leave, yes, you have a contract in place, a lease contract that requires them to continue paying rent. You can negotiate that. They can try and buy it out. Depending on the tenant, somebody like Starbucks, it's a pretty solid tenant. They're going to be around for a while. So even if they do decide to leave, it's not like they've gone bankrupt. But if you have another tenant in similar situation, and it's not as strong as any other large corporate tenant like a Starbucks, but happens to be like a local mom and pop, if we do go into a recession, those businesses are more likely to go bankrupt. And regardless of your lease contract or not, if they go bankrupt, everything's going to go to bankruptcy court, and whether you see that return or not is a different story. So an example of this Starbucks, it's a 10-year lease. They've got lease options as well, 4 or 5-year lease options. Still, when you look at this, you have a cap rate of 4.75%. If that Starbucks happens to shut down, then you lose that tenant. You would have to go find that replacement tenant or hire somebody to do that for you, and that's going to cut into your profits. Versus buying a treasury, you can even go out here to a 2-year treasury. You're getting 4.6% rate of return. You're not paying state income taxes, but you will pay federal income taxes. And depending on how you buy these, if you buy these in a tax deferred account, such as an IRA, SEP IRA, whatnot, you can actually save that money and pay the taxes later. Or if you have a Roth IRA, you don't pay the taxes since you've already paid the taxes prior to depositing the money in the Roth IRA. So this is a great way to invest this money. You don't have a risk like you have with owning a rental property. If the building burns down, yes, in that case, a triple net lease, the tenant is supposed to take care of everything. But if they decide, hey, the building burned down, we don't want to stay here anymore, we'll either settle, we'll try and buy out the lease, and then in which case you're back to square zero. If the building burned down, you get your insurance proceeds. There's insurance proceeds, however they're paid. You have to rebuild that. You have to take all the steps to set up a new building there and get a new tenant as well. Versus you're buying a government bond, risk-free, buy the bond, collect the interest. When the bond matures, you're good to go. Especially going into recession, we don't know what's going to happen. If the economy really slows down, the severity of the recession could impact all sorts of investments. So once you purchase that bond, it's going to stay in effect for as long as that bond has time on it. So in this case, if it's a 3-year bond, it's going to stay good for 3 years. It's going to be paying that interest for that 3-year time period. Here's another chart reflecting all real estate loans. Same thing, looking back at the Great Recession here, you can see the real estate loans peaked a little bit here, and then after we exited the recession, it went down. But now when we look at the number over here, basically in February 2023, we're at quite a high level in terms of the total amount of commercial real estate loans that are out there. So as that number goes up, there was a lot of easy money with the low interest rates, caused a lot of investors to go out and purchase properties, and as a result, they didn't necessarily look for the best deals, especially when their interest rates are low. 4.75% cap rate on like that Starbucks we looked at before, that makes sense. That's a good spread right there. So you're borrowing at a low rate. A lot of these were large hedge funds, large pension funds that have sitting on a lot of cash. They're not getting any money out of treasuries. So rather than sit there and earn pennies on the dollar in terms of interest, they can go buy a property like that Starbucks for 4.75%. Here's another chart showing the commercial real estate prices in the US. Same thing here. Here's the Great Recession. You can see the commercial real estate prices dropped. Q3 2009, reporting a negative 29%. So this is percent of change. So a negative 29%, the value dropped by 29%. Now it did go up. And then here in Q1 2022, last year, Q1, there was an increase in 13.9% in the rate of change. And now, as you can see, we're down to Q2 here, 2022. The percent of change in price is only 8.5% as of Q2 2022. So this data is lagging, so we don't know yet. We're here in Q1 2023. So it'll be interesting to see where this chart plays out over the next couple of months. So as you can see here are the average commercial rates taken today from this website StackSource. Today, February 13th, 2023. Ultimately, it's going to depend on the type of property, the type of commercial property, whether it's retail, large residential, storage units, industrial, and whatnot. So as you can see here, the rates vary on the low end, starting at the low 5s, all the way up to 9%. From your traditional lenders, you've got some debt funds there, which are willing to lend closer to 14%, 15%, which is on the high end. So these are the rates that current commercial real estate investors are going to be looking at when they want to purchase a property. So for example, here, even if you're borrowing, say, from a life insurance company for a large project, you're borrowing at 4.98%. Taking a look at the cap rate on our Starbucks property over here, you're only getting 4.75% back. Definitely in a couple years, once the lease options go up, you get increased rent, then your cap rate will increase. But at the same time too, why do you want to borrow at a higher interest rate and get paid back at a lower cap rate? Doesn't make financial sense. So that kind of shows that, especially with these types of properties where you're looking at a 4 or even a 5% cap rate, it doesn't make financial sense. So until commercial real estate prices start coming down and reflecting a higher cap rate where it makes sense to invest that money, if you're paying 4, 5, 6% interest rate, you need to be in the 7, 8, 9% cap rates in order to make sense for that investment. Yes, there are some tax breaks, and that does help, but at the same time too, you have a higher risk when you're owning real estate versus government bonds that actually have zero risk. So in my opinion, I think the commercial real estate is in a bubble right now. I think there is room to go down, especially as we enter a recession. During a recessionary period, values will go down. And what you do want to be doing is you want to prepare yourself. Don't sit on the sidelines, get frozen. Nobody can guess the actual top. Nobody can guess the actual bottom. If you're catching it on the way at the bottom and there's still a little bit to go, that's fine. If you're catching it on the way at the top, there's a lot more to go on top. That's great too. I did record a video on how to prepare for a recession. I'll leave that link up above. Take a look at that video, so that way you are prepared once we enter that recessionary period. So let me know your thoughts in the comments below. Do you think we are coming into a recession, and do you think that will impact commercial real estate? Why or why not? And if you could, please like and subscribe the video. I'd appreciate it. Thank you for watching, and I will see you in the next video.